Hi guys, it's Stock Curry, and we just got a hurricane of bad economic news. In today's video, I'm going to explain the jobs data and housing data that just came out, and I'm going to tell you about a warning from the CEO of a major bank. So let's get into it! A major jobs report just came out on Wednesday, and it showed that jobs openings fell by 455,000 in April. Now that helped close the gap between the number of job vacancies and the number of available workers. Keep in mind that the number of job vacancies is still extremely high compared to the number of available workers. And of course, unemployment is still historically low at 3.6%, which is near a 50-year low. Now, the real story here is the decline in the number of job openings, which has also lessened the gap between the number of openings and the number of available workers. Keep in mind, as I spoke on Larry Jones' channel last week, that the major issue is that as the job openings start to decline, and they could decline for a number of reasons. Either those jobs get filled, or what's really happening right now are companies are starting to do hiring freezes, which means the job openings that were there are no longer there. They've shut down the positions, and so they're no longer hiring for those job openings. Now, what's going to end up happening is this: people get laid off and those positions get filled, and as some of those open positions just go away, that is going to cause the number of available positions to start to decline. And what will eventually happen is the number of available positions will drop below the number of people who are unemployed. And once that happens, that is when we are in dire concern about a real recession starting to occur in the economy. Now, the thing about this is, it all starts with the gap between the job openings and the number of people looking for work starting to decline. And we just now, finally, in April, for the first time, saw that gap start to decline. So this is the first month. April is the first month where we saw a decline. And this is really the start of what's going to cause this major recession over, well, who knows when it's actually going to start. But this is what starts a recession. We are in the very, very early stages of it. So major red flag from the job market today. And as bad as that was, we got an even bigger red flag from the housing market. Mortgage rates are on the rise again. In fact, they rose sharply to 5.47% on Tuesday from 5.36% on Monday. That's a 0.11% rise in just one day. Now, here's the biggest problem of all. Keep in mind, as I said last month, that once mortgage rates hit 5.5%, we are officially in the most unaffordable housing market in the history of the United States. Currently, 2006 was still the most unaffordable time. However, once mortgage rates hit 5.5%, this will now be the most unaffordable time in history. And on Tuesday, those rates hit 5.47%, just 0.03% away from making this housing market the most unaffordable in history. So think, what happened in 2008 when we had the most unaffordable housing market in history? We entered a major financial recession, and we are now just 0.03% away from having the most unaffordable housing market in history, more unaffordable than 2006. So we are on the virtual edge of a major collapse in the housing market. And as I said in yesterday's video, we are already seeing housing prices start to go down, but the data is still from prior months, and the data is still showing housing prices rise as mortgage rates rise. It is a double whammy, and it is leading up to a major bubble burst in the housing market, which is going to cause a major collapse in the housing market, which will eventually hit the stock market. Now again, the housing market going down doesn't really affect the stock market for about 1 to 2 years. So we've got time on this, but this is certainly another major red flag showing that a major financial issue is on the horizon. And all of this, plus more, led Jamie Dimon to say, brace yourself for an economic hurricane. Now, Jamie Dimon actually listed two factors. One was quantitative tightening, and that is where the Fed starts to reduce their balance sheet. And what reducing the balance sheet does is not only does it raise interest rates from the Fed overnight level, but it also raises interest rates on both treasury yields, which means it's more expensive for the government to borrow money, and it also raises interest rates on mortgages, making mortgage interest rates rise even faster. In fact, that is the number one reason why we saw rates rise so much on Tuesday. Now, what's so shocking about Jamie Dimon coming out and saying brace yourself for a hurricane is the fact that just last week, literally just last week, Jamie Dimon said that we had storm clouds on the horizon which may dissipate. And literally in just 1 week, we've gone from storm clouds on the horizon which may dissipate to a hurricane that is coming. Holy crap, what changed that made him say this? Well, I think what changed that made Jamie Dimon go from storm clouds to a hurricane was the rising mortgage rates. In fact, he specifically calls out QT, or quantitative tightening, as one of his reasonings. And it looks like with this being the very first month of quantitative tightening and the way that mortgage rates rose so fast, that this really has Jamie Dimon scared. And keep in mind that the quantitative tightening is actually going to ramp up. We actually started this month with a very small amount of quantitative tightening. It actually gets much faster and much more aggressive as the months go on throughout the end of this year. Now, one thing that Jamie Dimon said that's actually going to make this whole situation worse is the fact that he said JP Morgan is bracing ourselves and we are going to be very conservative with our balance sheets. Now, as somebody who has worked in the financial industry before, I can tell you exactly what that means. Being conservative with the balance sheet means the exact same thing it meant in 2007, 2008. It means they're going to be tightening their lending standards. Keep in mind that it was the tightening of the lending standards at the end of 2006 and beginning of 2007 that caused the financial crisis to start in the housing market. When mortgage lenders started tightening their lending standards, that is what triggered the entire collapse of the housing market. And now Jamie Dimon is coming out and he's saying that JP Morgan is going to be tightening their lending standards, quote unquote, being conservative with their balance sheet, and that is going to trigger or make this entire economic situation even worse. But it's going to essentially speed up how bad this situation gets. So literally, he is taking evasive action right now, and that in turn is going to cause the economy to get even worse because it is lending that allows the economy to grow. It is lending that causes the economy to grow, with businesses borrowing money and being able to hire more employees and people being able to go out and get mortgages and buy houses. That's how the economy grows. But if banks start tightening their lending standards and they start causing less and less people to be able to get loans, then that means the economy itself contracts. And if we already had a contracting economy in Q1, that is just going to speed up the contraction in Q2, and it's almost certainly going to trigger a recession for the first half of this year. Now, the one thing that Jamie Dimon said that actually gives us a little bit of a timeline on when this recession might start is he said that U.S. consumers still have 6 to 9 months of spending power. Now, digging a little bit deeper, Jamie Dimon specifically said that high inflation is causing consumers to dig into their savings. In other words, people have about 6 to 9 months worth of savings left, and they're using those savings to buy food and gas and things that they need because they just can't afford them with their normal budget, so now they're digging into their savings. And what Jamie Dimon is saying is in about 6 to 9 months, those savings are going to be gone. And specifically for low-income earnings, those earning less than $36,000 a year, their savings are already gone, and they are really feeling the pain already. In another 6 to 9 months, the middle-class Americans, their savings are going to be gone, and that's when the economy is really, really going to go bad. So that's why Jamie Dimon and JP Morgan Chase, they're tightening their lending standards, because they know in 6 to 9 months, people just aren't going to be able to afford their mortgages and their loans anymore, and that's when we're going to start getting defaults, and it's just going to get really, really bad. I mean, think about it. If you have a choice between food or your car payment, most people are going to go choose to buy food for their family rather than make that car payment. And that's when these defaults start to kick in. So Jamie Dimon sees this on the horizon. He is preparing JP Morgan Chase to be able to weather this storm, but it's just going to cause the economy to get even worse. So 6 to 9 months, savings are going to be gone. That's going to cause people to no longer have the money to be able to afford the bills. And that's when we're going to start getting defaults. We're going to start seeing people spend a lot less on all the eating out and other things that they're doing right now. And that's when we could really see this recession start. Now, of course, all of this talk about higher interest rates has caused the 10-year Treasury yield to rise once again. It was at 2.92% as of the recording of this video. And keep in mind that we are very close to that 3% level once again. And the higher the interest rates go, that is going to make technology stocks go down because it makes borrowing costs much higher. It's also going to especially hurt stocks that rely upon borrowing just in order to survive. So a lot of the high growth stocks that have come down tremendously, we can expect to see continued downward pressure on those high growth stocks as these interest rates continue to go up. Now, if there's any good news for the markets, it's the fact that Brent crude oil prices are down. When I last talked about these Monday night, they were at $122 a barrel. They are now down to $114 a barrel. So we're definitely seeing a drop in oil prices, which is going to help boost the stock market. So we have some good economic news for the stock market, some bad economic news for the stock market. We technically are also stuck in this no man's land between the two Fibonacci retracement levels. So it remains extremely difficult to determine what the stock market is going to do over the next few days. I can tell you that the 1 hour and 4 hour charts remain bearish. So those are certainly putting some impact on the stock market, possibly going down again on Thursday. However, psychologically, I think we will continue to rise. So we might get another test on the SPY level of $407 on Wednesday before we continue higher. But it's also just as likely that we hit that $407 level and then just continue going lower. It's really hard to say. We are stuck in the middle of no man's land. I have no idea at all what the stock market is going to do on Thursday. It is a complete unknown. So unfortunately, with this mix of technicals and this mix of economic news, you just can't predict it at this point. I did open a call option when SPY hit $407 today, like I said I would in yesterday's video. However, I literally opened one call option because I find this to be extremely risky right now. Until we get some sort of confirmation on the technicals, one way or the other, up or down, I don't care. I just need some sort of confirmation which way we're going. Then I'll be a lot more comfortable opening some larger positions. But right now, with it being so uncertain, I am keeping my position sizes extremely small. Now, there is one additional option that I opened today, and I want to talk about that one right now. So earlier today, news came out that the COO, or Chief Operating Officer of Facebook, is stepping down. Now, Sandberg has been with Facebook since 2008, or about 14 years now. So this is a major loss for Facebook. And when the news came out, Facebook immediately dropped by about 2%. I mean, this is extremely bad news for Facebook. So because of this, I do expect Facebook to continue to drop in price. So that's why I opened a credit bear call spread on FB today. I have a $180/$185 strike price on that spread. I sold the spread for $2.85. So I'm going to have a max profit if FB closes at or below $180 on August 19th. And I do believe it will. Basically, Facebook just has to trade flat or go down for the next month and a half, and I will make money on this play. All right, the last thing I wanted to let you know about is the fact that Webull has finally introduced paper trading for options on their phone app. So if you wanted to learn options and you wanted to get into it, you wanted to make money with us, but you were just scared, you didn't really know a lot about options, you can finally open up a Webull account and paper trade options on the Webull phone app. This is a great way to learn and practice before you start using actual real money. By the way, get prepared now to use real money because Webull is offering their best promotion ever right now, and you only have a few days left to sign up and get the promotion. So all you have to do is sign up using my link in the below and deposit just $1, and Webull's going to give you 6 free stocks worth up to $12,600. Think about that. All you have to do is open an account using my link in the description below and deposit just $1, and Webull is going to give you 6 free stocks worth up to $12,600. Guys, this is an absolute no-brainer. Sign up for Webull using my link below. Even if you already have brokers, somebody like Charles Schwab or Fidelity or TD Ameritrade, go ahead and open up a Webull account because this is just free money that you're throwing away if you don't open this account right now. This is the best promotion they have ever had. 6 free stocks worth up to $12,600 for depositing just $1. Alright guys, I hope you enjoyed this video and got a lot out of it. If you haven't already, please remember to hit the like button and subscribe. And if you are on YouTube, go ahead and click the bell icon and click all so that you can get notified when I release my next video. I hope you have a lot of success trading, and I will see you tomorrow.